The dollar didn't crash, it slid. Quietly, almost politely. And that's exactly why it matters. Because the biggest shifts in markets rarely arrive with sirens. They arrive with a shrug, and then a scramble. Here's the contradiction that should make anyone pay attention. Risk assets can look strong on the surface while the currency underneath them weakens at the same time. That's not stability, that's rotation. And rotation is how wealth moves, before headlines catch up. Let that sink in. A reserve currency doesn't need to collapse to trigger a hard asset bid. It only needs to lose momentum, to break support, to signal that confidence is leaking. And once that signal flashes, capital does what capital always does. It looks for the next best store of value. Here's what needs to be understood. The US dollar is not just another currency. It's the unit of account for a massive portion of global trade. Commodities, energy, industrial metals, agricultural products, and especially precious metals are priced in dollars. So when the dollar weakens, the same barrel of oil, the same ton of copper, the same ounce of gold must reprice higher in dollar terms to represent the same real value. That's not hype, that's arithmetic. And that arithmetic creates a chain reaction. When the dollar falls against other currencies, foreign buyers suddenly need fewer euros, fewer yen, fewer yuan to buy the same ounce of gold priced in dollars. Demand rises, not because of emotion, but because of exchange rates. At the same time, domestic holders of dollars feel the slow bleed, the loss of purchasing power, and start searching for assets that don't depend on another institution's promise. Connect the dots for a second. That's two separate rivers of demand flowing into the same narrow channel. Now add a third, central banks. According to the World Gold Council, central banks have been net buyers of gold for years. And in 2022 and 2023, purchases exceeded 1,000 tons each year. Let me repeat that. The institutions that issue fiat currency have been accumulating the asset that has no issuer. That isn't a slogan, it's a behavioral tell. Ask a simple question. Why would monetary authorities increase their gold holdings in an era of sophisticated financial engineering and digital settlement? Because gold is the settlement asset when trust becomes the variable. But gold does not default. Gold does not miss a coupon payment. Gold does not require a counterparty to behave. This is not a prediction. It's a description of incentives. U.S. federal debt is now north of $30 trillion. Interest expense has climbed toward the $1 trillion per year range as rates rose. That creates a structural problem, not a political problem, not a partisan problem, a mathematical one. When a nation's cost of servicing debt grows faster than its capacity to grow real output, something has to give. Taxes can't rise indefinitely. Spending can't be cut painlessly. Growth can't be summoned on command. That leaves currency and financial repression and policy choices that quietly favor inflation over austerity. Let that sink in, not because it sounds dramatic, but because it changes how assets behave. When the market begins to believe that debt cannot be resolved honestly, meaning through repayment, in stronger currency, it starts to price in repayment in weaker currency. That is one of the oldest forces behind gold bull markets. This is where the metals' safe haven narrative often gets oversimplified. The real driver is not fear alone. The real driver is confidence in currency, in settlement, in the long-term purchasing power of the unit everything is measured in. So how does the rotation actually happen? Mechanically? Precious metals trade across multiple layers. There is the spot market, immediate settlement, often tied to physical availability and regional demand. There's the futures market, leveraged contracts that are used for hedging, speculation, and price discovery. There are also OTC markets and forward markets used by institutions. The key point is that futures can move fast, and physical can move tight. Here's where it gets really interesting. The difference between paper and physical is where stress shows up first. On paper, gold can be sold in seconds. Futures contracts can be dumped in size during thin liquidity, forcing price down sharply. But physical markets don't always agree. When physical demand remains steady or increases, during paper sell-offs, premiums rise, delivery tightens, inventories draw down, and eventually the paper price is forced to reconcile with physical reality. That's when repricing becomes violent. Now introduce silver, because silver is where safe haven rotation often turns into acceleration. Silver is not just a monetary metal, it's also an industrial metal. That dual identity makes it volatile, and it makes it sensitive to economic narratives. When growth fears rise, silver can get hit. When liquidity loosens, silver can rip. And when gold leads a precious metals cycle, silver often lags, until it doesn't. Historically, silver's catch-up phase is where the move becomes loud. Look at the early 2000s. The dollar peaked around 2001 and entered a multi-year downtrend. Gold, which had been suppressed for years, started climbing from roughly $260 an ounce. By 2011, gold touched about $1,220. Silver went from under $5 to nearly $50. That wasn't a gentle drift. That was a repricing driven by currency weakness, monetary policy, and a growing recognition that debt-based systems eventually search for an anchor. This is not to say the next move will match the last move point for point. Markets rhyme. They do not photocopy. But the setup today has echoes, and the echoes are getting louder. The modern geopolitical environment adds fuel. Sanctions have become a common tool. Supply chains have been reevaluated. Strategic resources have been politicized. And in that environment, reserve managers care less about yield and more about control. That pushes some demand away from foreign-denominated paper assets and toward assets with fewer strings attached. Again, this is not ideology, it's incentives. Now zoom in on supply and demand. Because safe haven narratives are incomplete without physical constraints. Gold supply grows slowly, annual mine production increases are incremental. Discoveries are expensive. Permitting is slow, and high-grade deposits are harder to find than they were decades ago. That means demand shocks matter. When investment demand rises meaningfully, especially from institutions or central banks, supply cannot respond quickly. Silver is even more constrained in a different way. A large portion of silver supply is produced as a byproduct of mining other metals like copper, lead, and zinc. That means silver supply is not purely responsive to silver prices. If base metal production slows because of recession, silver supply can tighten even if silver demand remains steady. That's a structural feature, and it matters. Think about that for a moment. Demand can rise quickly, but supply can be sticky or even decline. Then add the energy transition and electrification trend. Silver is used in solar panels, electronics, and various industrial applications. Demand can be cyclical, but the long-term trajectory has a persistent tailwind. When an asset is both monetary and industrial, it can behave like two markets layered on top of each other. And when both layers point the same way, moves can become explosive. Now, before the bullish story runs away, the bearish case has to be respected. Because metals can be punishing in the short term. A dollar bounce is always possible. If risk sentiment improves, capital can rotate back into equities and away from defensive assets for a time. If real yields rise, meaning interest rates remain high while inflation falls, gold can face headwinds. If positioning in futures becomes crowded, sharp liquidation events can occur. And silver, because it is thinner and more volatile, can drop 15 to 25% during corrections, even inside a long-term uptrend. Let that sink in. Not as a warning meant to scare, but as a reality meant to prevent mistakes. Markets do not reward certainty. They reward preparation and risk management. There's also the risk of policy intervention. Exchanges can raise margin requirements. Regulators can change rules. Large players can push liquidity in ways that create sudden price spikes down. None of that changes the long-term thesis, but all of it can change the path. And the path matters if timing is short. Now here's the pivot, the part that ties the whole picture together. Short-term bearish factors can slow a move. They can shake out weak hands. They can create drawdowns. But they do not erase the structural reason safe haven rotation begins in the first place. Currency confidence, debt dynamics, and settlement risk. Inflation is the symptom. The deeper issue is trust in the measuring stick. When the measuring stick wobbles, the value of everything priced in it has to be questioned. And that's why gold often moves first. Gold is the thermometer for monetary confidence. Silver then becomes the amplifier, sometimes the overreactor, because it is smaller, more emotional, and more sensitive to speculative flows. Now bring technicals into it, because technical levels are where psychology becomes visible. Gold's break above long-term resistance is significant because it changes the market structure. When an asset clears a multi-year ceiling, there's less overhead supply. Sellers who wanted out had years to sell into rallies. When that ceiling breaks, the market enters price discovery. Silver's chart often lags at this stage. Silver may still be wrestling with resistance levels from prior cycles, like the zone below the 2011 highs near 49. That doesn't make silver bearish, it makes silver coiled. When silver finally clears its own long-term resistance, the move can be abrupt, because silver is not a slow asset when it decides to move. Here's what to monitor, not as advice, but as a framework. First, the dollar trend. Watch whether the dollar continues to make lower highs and lower lows on a weekly basis. Watch the relationship to long-term moving averages like the 200-day. Sustained weakness matters more than daily swings. A brief bounce is normal. A structural breakdown is a different animal. Second, the gold to silver ratio. This is one of the clearest gauges of relative fear versus speculation within the metals complex. When the ratio is high, gold is leading and silver is lagging. When the ratio rolls over and falls, silver is typically gaining momentum, often in a risk-on way inside a precious metals uptrend. The direction of that ratio can reveal whether the rotation is broadening or staying defensive. Third, physical signals. Watch premiums, watch signs of tightness, watch inventory trends where available. Futures charts can swing wildly, but physical behavior tends to be steadier. And when physical behavior starts to diverge from paper price, the divergence is the story. Fourth, central bank behavior. Not speeches, behavior. Purchases, reserve composition shifts. Persistent accumulation is not done for entertainment. It is done for strategic reasons. Now, here's where conventional wisdom gets it wrong. Most commentary treats gold as a reaction, something that moves after something breaks. But in reality, gold often moves before the headline event. Gold is forward-looking. It sniffs out policy direction, liquidity changes, and currency confidence shifts ahead of time. Gold isn't only responding to CPI, it's responding to the credibility of the system behind the CPI. That's subtle and it's crucial. Now, consider the possibility that this is not just a dollar cycle, but a settlement cycle. For decades, the world ran on a simple assumption. Dollars were neutral. They were the lubricant of trade. But in a world where financial infrastructure is increasingly used as leverage, neutrality becomes a question. And when neutrality is questioned, diversification becomes rational. Gold is the default diversification when politics and credit risk enter the conversation. This is why central bank buying matters so much. It's not retail emotion. It's institutional preference revealing itself. Now zoom down to the individual level, because different participants experience this environment differently. For those holding physical metal, the purpose is not to trade every wiggle. The purpose is resilience. Physical metal is a hedge against systemic risk, against currency debasement, against the fragility of paper promises. It is slow until it isn't, and it tends to matter most when it feels least exciting. For traders, the environment is opportunity, but also danger. Metals can trend, but they also whip. Entries matter. Risk controls matter. Leverage can turn a correct thesis into a painful outcome if timing is wrong. The goal becomes capturing the trend while respecting the volatility. For long-term investors, the question is allocation, not obsession. Metals can act as insurance. Insurance is not supposed to be the entire portfolio. It's supposed to reduce catastrophic outcomes. Thinking in that framework changes behavior during pullbacks. For new participants, the most important point is expectations. Metals do not move like tech stocks. They are not a straight line. They are not a promise. They are a market, with drawdowns, with fake-outs, with periods of boredom. The reward comes from patience and understanding, not adrenaline. Now, there needs to be a clear warning here. This is educational information, not financial advice. No one can guarantee outcomes. Prices can fall sharply. Markets can behave irrationally longer than expected. The most common mistake in precious metals is confusing a strong long-term thesis with a requirement that the market pay off immediately. That mistake is expensive. Position sizing matters. Time horizon matters. Emotional control matters. Now, with that said, the core thesis remains simple. Dollar weakness changes incentives. It changes global purchasing power. It changes allocation behavior. And it tends to lift the floor under hard assets over time. They are mirrors. They reflect what the currency system is doing. When debt rises faster than trust, metals don't need a story. They become the story. Here are the practical signals that can confirm whether the safe haven rotation is accelerating. If the dollar continues to lose long-term support, if it fails to reclaim key moving averages and keeps printing lower highs, that strengthens the case that this is more than a temporary dip. If gold holds above major breakout zones and continues to post higher weekly closes, that signals institutional sponsorship, not just speculative excitement. If silver begins to outperform gold, visible through a falling gold-to-silver ratio, that often indicates the move is broadening from safe haven to momentum, where upside can accelerate. If physical premiums remain firm, even during paper pullbacks, that suggests real demand is not leaving, it's waiting. And if central bank gold accumulation persists, it signals that the largest players in the system are still hedging the system itself. Don't take any of this on faith. Verify it. Look at the charts. Read the World Gold Council reports. Check public economic data from sources like the US Treasury and the Federal Reserve. Compare narratives to numbers, because numbers don't care about narratives. Now, the big misconception that needs to be dismantled is this. A rising gold price is not automatically a sign of crisis. Sometimes it is simply a sign of repricing, of currency adjustment, or of liquidity movement. Sometimes it's just the market realizing supply is tighter than assumed, while investment demand has arrived at the same time. This is not about predicting the exact top or bottom. It's about reading the environment. And the environment is flashing a message. The unit of account is wobbling and capital is rotating toward assets that don't require trust to function. Let that sink in, because it explains why the move can start before the headlines and why waiting for certainty can mean arriving late. Now, a final dose of realism. There will be pullbacks. There will be sharp sell-offs that feel like the thesis is broken. That's normal. That's how trends behave. They climb a wall of worry, and they punish emotional decision-making. The long-term question is not whether volatility appears. The long-term question is whether the structural drivers reverse. Would debt suddenly shrink? Would deficits suddenly vanish? Would central banks suddenly stop diversifying? Would geopolitical fragmentation suddenly rewind? Would the incentive to protect purchasing power suddenly disappear? Those reversals are possible, spurt notice, but they would require fundamental changes, not weekly noise. So the takeaway is not panic. The takeaway is awareness and preparation. 3 core points to carry forward. First, the dollar's trend matters because it is the measuring stick. And when the measuring stick weakens, hard assets tend to reprice. Second, gold often leads safe haven rotation as the monetary barometer, and silver often follows as the volatile amplifier, especially when momentum broadens. Third, physical and institutional behavior, premiums, inventories, central bank accumulation can reveal stress and demand even when paper prices are choppy. Hold on to those 3. And remember the difference between entertainment and intelligence. Entertainment reacts, intelligence prepares. But dollar weakness doesn't have to be dramatic to be consequential. It just has to persist, long enough for capital to admit the truth and move. Because in markets, the most expensive moment is often the moment after the confirmation everyone was waiting for. The rotation starts quietly, then it gets obvious, and then it gets crowded. And by the time it feels safe, it's usually already expensive.